you own a second property right now, a holiday house, a rental, even a small unit you bought for your grandkids, it could be quietly cutting your age pension down to zero as it is concerned. And most retirees don't find out until Centrelink sends them a letter that changes everything. Here's the truth. As of the 1st of July this year, the rules around what counts as an asset changed again. And if you weren't paying attention, you might be losing hundreds of dollars a fortnight without even realizing why. So today we're going to walk through exactly what a second property does to your age pension. Nice and slow, no confusing jargon, just plain English. By the end of this video, you'll know exactly where you stand and what you can actually do about it. Welcoming. If you're new here, welcome to Centrelink Pension Bulletin. This channel is all about helping you understand your pension, your entitlements, and your rights, so you keep more of what you've earned. Let's start with the most important thing to understand. Centrelink does not care whether your second property is a beach shack, a farm, or a unit you're renting out to your niece for a bargain price. If you own it and it's not your main home, it counts. That's the first curiosity trigger for today, because there are actually a few surprising exceptions to that rule, and we'll get to them shortly. Let's start with the basics of the assets test, because everything flows from this. Your family home, the one you actually live in, is exempt. Centrelink doesn't count its value at all, no matter how much it's worth. But any other property, whether it's an investment property, a holiday home up the coast, or a place your daughter lives in rent-free, is treated as an assessable asset. Its full market value gets added to your asset total. Now here's where it gets serious. As of the 1st of July 2026, if you're a single homeowner, you can hold up to $333,000 in assessable assets and still receive the full pension. Once you go over that, your pension starts reducing. For a homeowner couple, that full pension threshold is $499,000 combined. Here's the part that catches people out. A second property can push you well past those numbers in one single stroke. Even a modest holiday unit worth $300,000 could take a single pensioner from a full pension straight into a part pension, or even close it off completely. Let's pause on that for a second, because I want you to really picture this. Imagine a couple, both aged 72, who've paid off their family home. They also own a small coastal cottage they inherited from a parent years ago. It's worth $400,000. They're not renting it out. They visit twice a year. But because they own it, Centrelink adds that $400,000 straight onto their asset total. Suddenly, a couple who should be receiving a healthy part pension may find their payments reduced dramatically simply because of a property they rarely even use. This is happening to real families right now, and it's exactly why we're covering it today. So how much does owning that second property actually cost you in pension payments? Let's talk numbers, because this is where people get genuinely surprised. Once your assets go over the threshold for the full pension, your payment reduces by $3 a fortnight for every $1,000 over that limit. That might not sound like much at first, but do the maths on a $400,000 holiday home, and you could be looking at a reduction of well over $100 a fortnight, sometimes considerably more, depending on your other assets. And if your total assets push you past the upper cutoff point, your pension can disappear altogether. For a single homeowner, that cutoff currently sits at $733,500. For a homeowner couple, it's $1,102,500. Now, here's a question worth sitting with. What if your second property isn't even making you any money? That's our next curiosity trigger, because the answer might surprise you. Even if a second property is sitting empty, costing you money in council rates and insurance, Centrelink still assesses it at full market value under the assets test. It doesn't matter whether it's earning you rental income or draining your bank account every month, but there is a separate test running alongside the assets test called the income test. And this is where rental income comes into play. If you're renting out that second property, the rental income you receive minus any allowable deductions gets added to your total assessable income. Centrelink then compares what your pension would be under the income test versus the assets test and pays you whichever amount is lower. So in many cases, owning a second property hits you twice. Once through the value of the property itself under the assets test, and again through any rental income you're receiving under the income test. This is why so many retirees with a second property end up on a much smaller part pension, or sometimes no pension at all, even though on paper they might feel like they're just an ordinary Australian couple with a family home and one extra place. Now let's talk about something that gives a lot of retirees real hope, and that's the exceptions. Remember, I mentioned there were some surprises. Here's the first one. If you're forced to sell your family home, say you're moving into aged care or downsizing, and you're planning to use the proceeds to buy a new home, those sale proceeds can be exempt from the assets test for up to 24 months. In some circumstances, that can even be extended to 36 months. This gives you breathing room. It means you're not immediately punished the moment you sell one property before buying another. Here's the second exception, and this one is important if you or your partner ever need to move into residential aged care. If you move out of your home due to illness or into care, Centrelink may exempt that home from the assets test for up to 2 years from the date you enter care. But take note, that exemption applies to your former family home. It generally does not extend the same way to a second investment property or holiday home. Here's a curiosity trigger worth remembering for later in this video. There's actually a strategy some retirees use involving granny flats and family arrangements that can completely change how a property is assessed. We'll touch on that shortly. Let's talk about another situation that trips people up. Deeming. If you decide to sell your second property and you're holding the proceeds in the bank while you decide what to do with the money, those funds don't just sit there quietly, ignored by Centrelink. Instead, they get caught by something called deeming. Centrelink assumes your money is earning a certain rate of interest, whether it actually is or not. As of the 1st of July 2026, the lower deeming rate remains at 1.25% and the upper rate remains at 3.25%. But here's the update worth knowing. The threshold at which you move from the lower rate to the higher rate has increased. For singles, it's gone up by $2,600, and for couples, it's increased by $4,400. That might sound small, but it means slightly more of your money is assessed at the lower, friendlier rate before the higher rate kicks in. For some retirees, that translates into a small but genuine increase in their pension payments. Now let's come back to that granny flat idea, because this is genuinely useful information for many families watching this video. Some retirees transfer money to a family member in exchange for the right to live in a granny flat on their property, often permanently and rent-free. Centrelink has specific rules around what's called a granny flat interest. If structured correctly, this arrangement can sometimes mean the family home you're living in is treated differently under the assets test compared to owning a straightforward second property. This is a complex area though, and it genuinely pays to get proper advice from Services Australia or a financial counsellor before making any decisions here. The rules are specific, and getting them wrong can create bigger problems than the ones you started with. Let's talk about one more scenario that applies to quite a lot of families. What happens if your adult child or another family member lives in your second property rent-free? Even if you're not collecting a cent of rent, Centrelink still assesses that property at its full market value under the assets test. The fact that no money is changing hands doesn't exempt it. Many retirees assume that because they're not profiting from the arrangement, it won't affect their pension. Unfortunately, that's not the case. So what should you actually do if you're in this situation? First, get an accurate, up-to-date valuation of your second property. Don't guess, and don't rely on an old figure from years ago. property values shift, and Centrelink wants a realistic current market value. Second, speak directly with Services Australia or book an appointment with a financial information service officer. These appointments are free and they can walk you through exactly how your specific situation is assessed. Third, consider speaking with an independent financial advisor who specialises in retirement planning. There are legitimate legal strategies that can help you structure your assets more effectively, but they need to be tailored to your exact circumstances. And finally, keep a close eye on threshold changes. Remember, these limits are reviewed and adjusted in March, July, and September every year based on the cost of living. What applied to you 6 months ago might not apply to you today. Here's something worth remembering before we wrap up. Right now, a large number of pensioner households in Australia are homeowners, and a meaningful proportion of those homes are worth well over $1 million. That means many retirees watching this video may be sitting closer to these thresholds than they realise, especially once a second property enters the picture. Owning a second property isn't necessarily a bad thing. For many retirees, it represents years of hard work, family memories, or a genuine investment for the future. But going in with your eyes open, understanding exactly how it affects your pension, can save you from an unpleasant surprise down the track. If this video helped clear things up for you, please give it a thumbs up. It genuinely helps this channel reach more retirees who need this information just as much as you do. If you haven't already, subscribe to Centrelink Pension Bulletin so you never miss an update when these thresholds change again. And if you have a question about your own situation, drop it in the comments below. I read every single one, and many of your questions end up shaping future videos on this channel. In our next video, we're going to break down exactly how gifting money or assets to your children affects your age pension, and the strict rules Centrelink has in place around it. It's a topic that catches out even the most careful retirees, so make sure you're subscribed and ready for that one. Take care of yourself, look after your finances, and I'll see you in the next video.